And welcome back. A measure of inflation very closely watched by the Federal Reserve picked up in April, making for a very difficult decision by the Fed if they should raise rates once again next month. In today's video, I'm going to share a summary of that inflation report and also the impacts to our U.S. housing market, especially regarding home buyers. I'm also going to discuss some more early indications of home buying demand so we can gauge which direction our U.S. housing market is headed. I have a lot to share in today's video. Thank you so much for joining me. Let's begin. So here's an article I pulled from a CNBC. It says inflation rose by 0.4% in April and increased by 4.7% compared to April 2022. This is based on the Personal Consumption Expenditures Price Index, or their PCE index by the Fed. And this, by the way, is a measure of the changes in prices of goods and services that consumers pay in the United States, of course. The PCE price index here. So their index here, which of course is a measure of inflation, very closely tracked by the Fed. It says here, inflation stayed stubbornly high in April, potentially reinforcing the chances that interest rates could stay higher for longer. So this PCE price index rose by 0.4% for the month, excluding food and energy costs because there was a lot of volatility in the prices for food and energy. That 0.4% increase compared to March was higher than the expectations for a gain of 0.3%. Also on an annual basis, this gauge increased by 4.7%. The expectation was a 4.6% increase year over year. Also, including food and energy, headline PCE also rose by 0.4% and was up by 4.4% from a year ago, higher than the 4.2% rate we saw in March. So here's the actual report from the U.S. Commerce Department just announced on May 26. Here's their PCE, excluding food and energy. Again, it increased by 0.4% compared to March. The expectations was an increase of 0.3%. So in looking at the percent compared to the previous month, there hasn't been a lot of movement, relatively flat ever since December last year. And obviously, we don't want to see this because we want to see prices that you and I pay for goods and services to come down, because that would be an indication that inflation is also coming down, which also would support the Fed to not increase rates in the near future. In fact, we're seeing just the opposite though, because inflation coming in hotter than expectations. Also, compared to 1 year ago, it increased by 4.7%. The expectation was a 4.6% increase year over year. Also, just like the month over month changes, the year over year changes haven't moved very much as well. Inflation remaining very, very sticky for goods and services that consumers are buying in the US. So you may be asking yourself, how does this impact home buyers and the US housing market? And the answer is right here, because once this report was announced this morning on May 26, the yield on the 10-year Treasury note spiked. At the time of filming this video, which is around noon Pacific Standard Time, the yield is fairly flat compared to yesterday. But here's what happened though. After that inflation report was announced, let me just refresh this. This is from the CME group, and this is what's called their Fed Watch tool. You can Google this to see the probabilities of future rate hikes and rate cuts by the Fed. So take a look at this. This is pretty wild. The next Fed meeting is on June 14th, and that's to increase the federal funds rate to 5.50%. The current rate right now is at 5.25%. So the probability right now of a rate hike of 25 basis points is at 66%. Just 1 week ago, though, the probability was only 17%. Back then, it was an 82.6% probability that the Fed was going to pause rate hikes in their next meeting in June. So because this inflation report came in higher than expectations, that caused the yield on the 10-year US Treasury note to increase. And again, the yield on the Treasury note, or the 10-year Treasury note, is tied more directly to the direction in mortgage rates. So because the yield was increasing this morning, that caused average rates to increase once again for mortgage rates. So according to Investopedia.com, as of May 26, the average 30-year fix increased to 7.53% for people with exceptional credit. Absolutely insane. Also, according to the Mortgage News Daily, for a 30-year fix, it increased to 7.14%, a 2 basis point increase compared to Thursday. And also, FHA and VA is around 6.75%. So the rate right now at 7.14% for a 30-year fix is the highest rates we've had going back to early November last year. Also, this is nearly a 2 percentage point increase compared to 12 months ago, because 12 months ago, average rates were at 5.25% for people with exceptional credit. So the impacts regarding home buyers right now, I mean, this is crazy. 30-year fix at nearly a 7-month high right now. Absolutely insane. So I want to share an example. This is a common example I share on the channel based on someone looking to buy a median price home today compared to 1 year ago. So for someone buying a $400,000 home, putting 5% down at 5.25%, the rate from 1 year ago, your housing payment of principal and interest would be just under $2,100 per month. Look at this though. Same scenario at 7.14%, the rate as of Friday, $2,645 per month. That's an increase of $547 more per month to buy a median price home today compared to 1 year ago. That's a giant increase of 26%. But wait, there's more, because rates have increased by approximately 2 percentage points compared to 1 year ago. This causes a 20% decrease in buyers' purchasing power. And also, number 3, this is also something that I'm not really hearing a lot of people talk about, is because rates increase from 5.25% to 7.14%, the amount of interest paid over the life of that 30-year fixed rate loan is a whopping $560,000. That's an increase of $185,000 more in interest paid over the life of the loan because rates increased by almost 2 percentage points. So taking a step back here, not only are you paying approximately $550 more per month to buy a median price home today compared to 12 months ago, a giant increase of 26%, but also you're paying approximately $185,000 more in interest paid over the life of that loan. So obviously this has a big impact regarding people right now who are looking to buy a house, your average monthly housing payment going up, and of course your purchasing power also decreasing as well. Now here's something that you guys should be aware of as well, is that back in May 11th, just about 2 weeks ago, your average rate was about 6.49%. Now has increased by about 60 basis points, now at 7.14%. So I'm really going to be focusing on early signs of home buying demand, early signs of our U.S. housing market, so we can gauge where U.S. housing market is headed here. So here's what we know as well, because this is based on a report I posted on Thursday last week. The amount of applications for home loans, so home buyers who are submitting applications to buy houses, or applications for home loans to buy houses, decreased by 4% compared to last week. This is actually for the week ended May 19th. And also their purchase index is down by 30% compared to a year ago. So as I shared on that video, the current index, or their current demand for home loans, when looking at pre-pandemic levels, is at the lowest levels going back to January of 2015. Additionally, their purchase index hasn't been this low in 11 weeks this year as well. So I'm going to guess that the amount of applications for home loans is likely to decrease in the weeks and months ahead if rates stay at or above 7%. Here's something we also know as well. When looking at Google Trends, looking for people searching on Google for homes for sale, that's actually down compared to 1 year ago. Their index right now is at 83. 1 year ago, it was 91. This means there's approximately 9% fewer people searching for homes for sale compared to the same time frame 1 year ago. Also, as I mentioned in previous videos as well, is that the amount of people searching for homes for sale has been relatively flat all year. Also, according to Redfin's Home Buyer Demand Index, which is an index which measures requests for home tours and other home buying services from Redfin agents, that decreased by 1% year over year. As you can see right here, slightly below 2022's levels. And this is a clear indication of what happened last year. Demand for Redfin agents absolutely plummeted once we hit April. And back in April, that's when average rates increased to 5% from the 3% rates we saw back in 2020 as well as 2021. And by the way, right here is right when the Redfin announced layoffs in their company as well. So anyways, home buying demand, according to Redfin, is down by 1% year over year, and also well below 2021's levels as well. Also, according to ShowingTime.com, they actually track the number of real estate showings across North America compared to the first week each year. So for this year, it's up by 18.5% compared to the first week this year, whereas last year it was a gain of 6.2% compared to the first week of 2022. So you may be asking yourself, why are there more real estate showings this year compared to the same time frame last year? In my personal opinion, it's due to two main reasons. Number one, we have a lot more houses for sale right now compared to last year. Approximately 30 to 40% more houses for sale right now compared to last year, according to data from Realtor.com as well as AltusResearch.com. And number two, as I note right here, this could be higher than last year because this reflects the fact that home buying demand was falling around this time last year due to rates increasing greatly. So one more thing I do want to mention, this is super important because even though the number of real estate showings is much higher now compared to the first week this year, this has not translated into more closed home sales or more contracts being signed between buyers and sellers. In fact, according to Redfin, pending home sales decreased by 17.4% compared to the same time frame 1 year ago. With that said, what's your biggest takeaway from today's video? Please leave me a comment below. And of course, I appreciate you. Thank you so much for watching today's video. Have an awesome day, and I'll see you on the next video.